Hello, this is part one of what's probably going to be 5 separate videos, one on each chapter that is being covered in the midterm exam. By now, you should have seen that there is a file attachment, a short Word document that just gives you a summary of several bullets of things that are important for you to know for the exam from each chapter. And included in there is a video example that I wanted to go through for each chapter. That's going to be a fairly comprehensive problem. So without belaboring the bullets, since they are there for you to see, and shouldn't be anything surprising about them. That's what most of the uh, chapter discussion and the exercises and problems and the quizzes have pretty much been about up till now. So without any further ado regarding chapter 14, and maybe if you have exercise 14-14 open so that you can follow along with the information given, and while I take you through the solution to the problem, that would be helpful. Now, one of the bullets was to understand the cost of goods manufactured schedule and how to prepare one. And it's also important to know what happens to the cost of goods manufactured once we prepare the financial statements. And this problem I selected because it does a good job of taking you through all of that. And what it does is give you a lot of cost information that it then wants you to compile into a cost of goods manufactured. So that's part A, and let's jump right into that. So the first thing in the cost of goods manufactured is our beginning work in process inventory balance, in this case January 1st, which is $13,500. Then it gives you a bunch of information regarding materials, specifically direct materials. It gives you an inventory on January 1st of 21,000. Then the next thing is how much material was purchased during the year. That's 150,000. We add those two together to get what's called the materials available, which is 171,000. Then we have an ending inventory of direct materials on December 31st of 30,000, which we need to subtract from that materials available balance in order to get the direct materials used. Very important for you to understand the relationships here, the formula that I believe you should have learned in financial accounting class regarding beginning inventory plus purchases minus ending inventory. In that case equal the cost of goods sold. We were talking about a merchandising example. Here it's direct materials, so beginning inventory plus purchases minus ending inventory equals the direct materials used. And so that's the 141,000 that you see there. Then, as we follow along with the cost of goods manufactured schedule, we simply need to add the amounts they gave us for direct labor of 220,000, manufacturing overhead for 180,000, and that gives us a total manufacturing cost between the direct materials, direct labor, and manufacturing overhead of 541,000. However, we need to add that beginning inventory way up at the top to that 541 in order to get a total cost of work in process. So we got a lot of different pieces here to this puzzle, and it's important for you to understand each step of the way and each part of that puzzle for you to understand what's going on with the cost of goods manufactured. I must be reminding you at this point, for those of you old enough to remember Home Improvement, of the character Wilson. Never saw any more than that of his face across the fence. But anyway, I digress. Cost of goods, total cost of the work in process is 554,500, and hopefully everybody sees that as the sum of the total manufacturing costs that were computed above: direct materials used, direct labor, manufacturing overhead of 541, plus the beginning inventory work in process of 13,500. Then we, as the last step before we get the cost of goods manufactured, we need to subtract the work in process inventory on December 31st of 17,200. Again, all these bits of information were given to us. It's just a matter of how we arrange them in order to come up with the correct answer for the cost of goods manufactured, which is 537,300. So that's part A. Now, I hope this too is reasonably readable. So part B is the partial income statement. And the reason that this is important is that here you see how the cost of goods manufactured that we just computed is used in computing the cost of goods sold, which is a critical part, of course, of the income statement. So we start with the sales revenue of $910,000, and then we go into the cost of goods sold and how to compute that. And again, it's a beginning inventory of finished goods at 1/1 of 27,000, plus in this case, since we're not a merchandising business but a manufacturing one, the cost of goods manufactured. So that kind of takes the place, and this is kind of jumping ahead to part D of the problem, of the amount of goods purchased in a merchandising concern. Here we have the cost of goods manufactured, which we computed as 537,300. That, when it's added to the finished goods beginning inventory of 27, gives us a cost of goods available, COGA there, of 564,300. So you can see the pattern here is very similar to what we did for the direct materials in the cost of goods manufactured. So then from that cost of goods available for sale, we need to subtract the finished goods ending inventory at 12/31 of 21,000. Again, all this information was provided. And when we do that, we get the cost of goods sold as 543,300. So hopefully everyone understands how we got to that point. And when we subtract the cost of goods sold from sales revenue, we get a gross profit of 366,700. Keep in mind as we go forward into the future chapters regarding cost, volume, profit analysis and contribution margins, that the gross profit is a totally different animal than the contribution margin. Excuse me. But that's for a later time. Now the last part, or the last numerical part of the problem, asked you to do a partial balance sheet to show, amongst other things, the work in process inventory. So this is where that ending balance of work in process inventory shows up. Remember, this was used in computing the cost of goods manufactured, but it does not go on the income statement. It goes on the balance sheet because it is a part of the overall inventories, which are current assets. So hopefully everyone understands the reasoning behind that. So we have three different inventories in a manufacturing concern. The finished goods, which is 21,000, and notice that came from the income statement also as a subtraction. Much the same way as the work in process inventory of 17,200 came to us from the cost of goods manufactured schedule, from which it was also a subtraction in order to get the cost of goods manufactured, and the raw materials of 30,000, which there again was a subtract item in getting the cost of the direct materials used in the statement of the cost of goods manufactured statement, or schedule, I should say. So anyway, you add these three together, you get total inventories of 68,200. The final part of this problem was part D, which was simply asking whether or why the manufacturing example would be different from that of a merchandising concern. We already touched upon that, in that the merchandising concern would be a lot simpler. We'd simply have the merchandise inventory, we'd have a beginning inventory, we'd have the amount purchased during the year, which again would be akin to the cost of goods manufactured, and we'd have an ending inventory of merchandise, and when we subtracted that ending inventory from the goods available for sale, we'd get the cost of goods sold. So that wraps up Chapter 14, Managerial Accounting Introduction. Again, look at those bullets that are on this summary sheet, and make sure that you understand these things, managerial versus financial accounting, the management functions of planning, directing, and controlling, the three components of manufacturing costs: direct materials, direct labor, manufacturing overhead. Raw materials may consist of direct and indirect material, factory labor, direct and indirect labor. Factory labor includes all costs associated with the labor, not just the wages. Understand the flow of how these accounts get debited and credited along the way. And finally, of course, the cost of goods manufactured schedule, which we just went through an example of. So that does it for Chapter 14. Stay tuned for another one of these on the other chapters.